The end goal of many dividend investors is to generate enough income to cover their living expenses. There are really only two ways to do that faster. You can either generate more income or save more money. In today's video, we're going to deal with the first point. More specifically, I'm going to show you an interesting strategy that you can use to generate more income from your investment portfolio, called the covered call option strategy. The covered call option strategy is fairly complex, and I want to make sure to answer all of your questions. So this is going to be a fairly comprehensive video. Here's what we'll be talking about today. What is a covered call option strategy? How to select which covered calls to sell, and then we'll go through 3 covered call examples, using blue chip stocks, AT&T, Microsoft, and Facebook as examples. To understand what a covered call option strategy is, you have to understand what a call option is. A call option is a type of stock option. Here's the formal definition of a stock option. A stock option is a contract between two parties in which the stock option buyer purchases the right, but not the obligation, to buy or sell 100 shares of an underlying stock at a predetermined price, called the strike price, from or to the option seller within a fixed period of time. If the option allows the buyer to buy the security, then it's called a call option, which is the subject of today's video. Conversely, if the option allows the buyer to sell the security, then that option is called a put option. Each stock option corresponds to 100 shares of the underlying security. This is important to keep in mind because if you don't know this, you might end up playing with more money than what you intended. Because of this nuance to the options world, the covered call option strategy is not really suitable to investors who only have a small amount of money invested. Now, let's talk specifically about the covered call option strategy. In a covered call option strategy, you sell a call option to someone else on 100 shares of stock that you already own. Because you already own the 100 stock, that's why it's called a covered call. If you didn't own the stock, it would be called a naked call. Now, when you sell that stock, you get an option premium in exchange. Someone pays you for the option. That's the component of this strategy that allows you to generate income. The downside to a covered call option strategy is that if the stock rises to a price above the strike price of the options that you sold, you may be forced to sell the stock at a price that's below its market price. There are ways to avoid this, which we'll talk about later, but for now, that's a good summary of the covered call option strategy. An image is helpful in understanding the payoff profile of a covered call. Here, the underlying stock price is on the horizontal axis and the strategy's payoff profile is on the vertical axis. As you can see, the upside of the strategy is capped after the underlying passes the strike price of the call options. In an ideal scenario, the stock that you sold covered calls against will trade below the strike price of the call options for the entire duration of the option's life. Now, in practice, that isn't always the case. I would be remiss if I didn't talk to you about the alternative scenarios of trading covered call options. The alternative scenarios that I'm talking about is when the stock's market price rises above the strike price of the call options. In this scenario, you really have 2 options. The first is to forcibly sell your stock at a price that's below the stock's current market value. The price that you'll be selling at is, of course, the strike price of the options that you sold. Now, for obvious reasons, this isn't beneficial because if you hadn't sold the covered calls, you would have been able to sell this stock at a higher price and made more money. There is a way to avoid this, however. It's called rolling your options forward. What you do here is you buy back the covered call that you had sold previously, which will obviously generate you a loss because the call option will have appreciated in value. And then to partially offset that loss, you sell an additional covered call at a higher strike price that's out of the money. Moving on, the next section of this video is going to explain to you how to decide which covered calls to sell for a particular security. The science and strategy of choosing which covered calls to sell is well beyond the scope of this video. It can be endlessly optimized by quantitative investors. If you're anything like me, you just want a simple and repeatable strategy that you can use to generate more income over time. And that's exactly what I want to share with you today. In my experience, an excellent way to identify call options to sell against your portfolio holdings is by targeting options with the following characteristics. Stock options with 45 to 60 days until expiration, and with strike prices that are approximately 1 standard deviation above the stock's current market price. To help you better understand how to implement these guidelines, I'm going to show you 3 actionable examples of real-life blue-chip stocks and how you can trade covered calls against them today. The first covered call example that we'll explore is AT&T, which trades under the ticker T on the New York Stock Exchange. Now, keep in mind that this example will be longer than the other 2 because there are certain nuances with trading options that I'll need to explain along the way. When you look up stock options on your broker's trading interface, you'll usually be presented with what's called an options chain. And what this is a list of stock options for the particular expiration date on a given security. For example, here is the options chain for AT&T options that expire on July 20th, 2018 using my Interactive Brokers trading interface. You can see AT&T's ticker in the top left. Nearby, you can see that I have selected the July 20th expiration date, which at the time of this recording has 44 days until expiration. With this broker, hovering over particular strike prices will show you the standard deviation difference between the security's current price and the strike price that you're looking at. In AT&T's case, the $36 call options are exactly one standard deviation above its current market price, making them a prime candidate for our covered call strategy. We have now determined what call options we want to sell. The next step is to decide how much we want to sell them for. Now, there are two nuances that make trading options different to trading stocks that I'm going to discuss right now. Firstly, stock options are relatively illiquid compared to their common stock equivalents. As you can see by examining AT&T's option chain, there is a real bid-ask spread for each of the strike prices in the options chain. As an options seller, which is what we're doing in a covered call strategy, you should always budget to receive the bid price. The second unique aspect to doing a covered call option strategy is that even though one options contract corresponds to 100 shares of stock, the price of the contract is always quoted on a per share basis. In the case of AT&T, you can see the options are quoted at 25 cents per contract, which really means that for a 100 share contract, you will receive $25 for selling the option. We've now decided what calls to sell and how much to sell them for. Our last step is to determine how much additional portfolio income this will generate for us, expressed as a percentage of our AT&T stock's market value. We can do so using this formula. The formula has two factors. The first is option premium divided by stock price, which gives you how much absolute return you received expressed as a percentage of stock price. The second is 365 divided by the days until expiration of the option, which turns your absolute return into an annualized figure. This is important because almost all rates of return in finance are expressed as an annualized basis. So this improves the comparability of the covered call option strategy. In the case of AT&T, here's what the math works out to. We receive a 25 cent per share option premium while the stock is trading at $33.46. The option had 44 days until expiration. This provides an annualized return of 6.2%, which is particularly good when you consider the fact that AT&T already has a dividend yield of 6%. This means that dividend investors can receive passive income of about 12% by investing in AT&T stock and combining it with a covered call option strategy. Next, I'm going to provide similar tutorials for Microsoft and Facebook, skipping some of the more nuanced details that I provided in the AT&T example. Still, I recommend that you watch this video through to the end so that you can really cement the knowledge of the covered call strategy by watching more examples. Next up is our covered call example using Microsoft. You can see the company's options chain here. As before, the company's ticker is shown in the top left and the expiration date of the options we are looking at is shown just below that. In this case, the $110 strike price is approximately one standard deviation above Microsoft's current price. These options have a bid of 59 cents per share or $59 per option contract, which corresponds to 100 shares. Here's how we would calculate the additional yield that we would receive by owning Microsoft and selling these covered calls against it. The $110 strike price options dated July 20th are selling for 59 cents per share, while the stock is trading at $102.42. The contracts have 44 days until expiration. This provides an annualized return of 4.8%, which is roughly twice Microsoft's current dividend yield. Next up, I'm going to show you how to do a covered call option strategy on Facebook. Now, this example is pretty unique because Facebook is the only company we're talking about in this video that doesn't already pay a dividend. Because of this, Facebook is a great example of how you can generate passive income from stocks that don't pay dividends using a covered call option strategy. As before, let's consider Facebook's option chain. You can see the company's options chain for July 20th, 2018 here. In this case, it turns out that Facebook's $205 call options are 1.1 standard deviations above its current market price. This is as close as we can get to one standard deviation for Facebook stock at this expiration date, so these are the best options for the strategy I described previously. You will note that the options are selling for $1.14 per share right now. Here's how we would calculate how much additional passive income expressed as a percent we would get from owning Facebook and selling these covered calls against it. The options contract are priced at $1.14 per share, while Facebook is trading at $190.76 per share. The contracts have 44 days until expiration. This provides an annualized yield of 5%. That concludes the examples for today's video. After watching this through to the end, you should have a solid understanding of how to implement a covered call option strategy. If you take anything away from this video, let it be this. A covered call option strategy allows you to generate more portfolio income in exchange for a capped upside. The covered call strategy also allows you to generate passive income from companies that don't pay dividends. Thanks for watching today's video. I want to invite you to subscribe to this channel and to like this video so that you can stay informed about the latest investing content from Dividend.